over to you.
All right, Charles, here we go. So the Fed, there is no change on interest rates, no change. That was as expected. They're leaving the Fed funds target rate between 0 and 0.25%. But there is big news on the taper and the balance sheet. First to the taper. Right now, they've been buying $60 billion a month in total. They're now taking that down to $30 billion a month. Here's the breakdown. They're going from $40 billion a month in treasuries down to $20 billion a month. That's for treasuries. Then, as far as mortgage-backed securities go, they're going to take that down from $20 billion a month down to $10 billion a month. So this is more of the taper, if you will. Now let's go to some of the things that they're saying in the statement really quick here. First up, let's talk about the actual, this is new. It's called Principles for Reducing the Size of the Federal Reserve's Balance Sheet. Remember, this is a $9 trillion balance sheet. A lot of people have had a lot of issues with this balance sheet. Okay, they're basically giving us, and we haven't really seen this ever really from the Federal Reserve, they're giving us a guideline of how they're going to start to shrink the balance sheet of the Federal Reserve. They're starting the discussion, if you will. Okay, here is the big line out of the second piece of the paragraph. The committee expects that reducing the size of the Federal Reserve's balance sheet will commence, okay, after the process of increasing the target range for the federal funds rate has begun. What does this mean? If we know, and they've already told us they're going to stop the bond buying, all of that, in March, okay? They're going to pull back that. That's the taper. The taper ends in March. If the market's expecting that first interest rate hike in March, they're telling us that possibly the balance sheet could start to actually start to change over in March. A couple of more headlines I want to give before I send it back to all of you guys. In particular, we're seeing Treasury yields slip right now after this statement. The 10-year yield is now trading at 1.7815%. Basically, they're teeing up, and this is the headline here, they're teeing up that interest rate increase for March, which is what a lot of market watchers have been expected. Again, we're staying at 0.25%, 0 to 0.25% on interest rates. But over the long run, here's another thing, another headline. They're aiming for Treasury-dominated holdings at the Federal Reserve. Treasuries, not mortgage-backed securities. Treasury. That could be good for homeowners. I got to put my own 2 cents on that one, Charles. Again, the balance sheet reduction. They want to make sure that this is predictable, and they're laying all of this out in this press release that I was just reading to you really quick here. They're saying that basically that reduction, they want it predictable, and that they also want that reduction to happen via a reinvestment pace. They're also saying, again, that Treasury, that they're going to really focus on Treasury holdings, if you will. Really, I'm sending it back to you guys for, I'm looking at the VIX really quick. The VIX, the volatility index, actually slipping to a fresh 5-day low after the statement, which is interesting. And again, we're seeing market reaction again. But again, in those yields, I was looking at those yields. But now, U.S. Treasury yields, after that quick slide, after the statement came through, now they're rising a little bit. The 10-year is now at 1.08% and change. All right, so those are kind of the big headlines. But again, it is the taper. We thought it was going to end in March. It will, Charles. And then as far as that balance sheet production, they're giving us a framework, basically, giving us all the instructions that we need. If the markets can't handle that, then I don't know what the markets can handle anymore, Charles.
Oh, well, the markets are always in conflict. There's no doubt. Thank you so much, Cheryl.